This conference will now be recorded.
Good morning, everyone, and welcome to the ICG's Digital Academy webinar series. I'm Sally Alsop, the ICG committee member responsible for our webinar programme. Next slide, please, Claire.
I'll try. There we go.
Fantastic. So today's webinar is all about pensions, and for this we're delighted to welcome Claire Labrum, ICG member and director of Strictly Financial. Claire is a specialist in financial research. She has worked on both sides of the fence for financial service companies and research agencies, which allows her to see both the creative and commercial potential of research. She has a wealth of experience in product enhancement, development and innovation, as well as being well versed in the complexities of brand-related issues, having been involved with several large strategic brand and communications projects. Claire was made a Fellow of the MRS in 2021 in recognition of her contribution to the industry. So Claire is not a professional financial advisor, but she has kindly agreed to provide a layperson's overview of how pensions work and how they compare to other investments. She will cover the basics of pensions, what they are and what they are not, how they are treated for tax purposes, the limits surrounding contributions, and the rules about accessing your money. She will also attempt to show the difference between pensions and other investment options. Claire's happy to take questions at the end, so please type your questions into the chat box as we go along and have them ready to ask, or if you prefer, I'll read them out for you when Claire has finished her presentation. Next slide, please, Claire. So we're really grateful to Teneo Translations for sponsoring this webinar. The owner, Chris Barella, is also an ICG member. Teneo is able to handle any size translation or interpreting assignment into any language and has broad experience of the market research sector. Next slide, please, Claire. Before I hand over to Claire, here are some more webinars and events we've planned for you for the autumn. Don't forget that we're able to offer great value sponsorship opportunities with each of our webinars. Sponsorship normally costs £120 for a lot of exposure on our website, mailers and social media, and of course on the day. Please contact Lucy if you'd like to know more. Next slide, please. So our speaker today is Claire Labrum, ICG member and director of Strictly Financial, and I will now hand over to Claire, or let Claire take over.
Okay. Good morning, everybody, and welcome to this talk. I was asked to prepare a Pensions 101, so a basic explanation of pensions and how they work. Which is what I've done. A few disclaimers just to start. I do have experience in financial services sector. I am a financial specialist when it comes to research, and I've done a lot of work around the pensions area. But I am not a financial advisor or in any way qualified to give professional advice. Nothing in here constitutes advice. I am saying this because in the financial services industry there is a very clear definition of what advice is and what advice isn't. So I am saying this up front just in case anything should happen in the future. So please treat this as an informed layperson's guide to pensions. It's based on my personal understanding and experience, and I have looked at all of the tax implications and regulations relating to the 22-23 tax year. It may be different in the future, particularly with Liz Truss and some of the noises she is making about what she may or may not do with pensions, but this is the understanding as it stands today. If I can move it on. Right, so having told you that I'm not a financial advisor, I will give you a quick overview of what a pension is and is not. Fundamentally, pensions are relatively simple. They are you exchanging or putting away disposable income today so that you are able to have an income in the future. It's a savings plan. at its very basic level, but it's a savings plan with tax breaks. And those tax breaks are called a wrapper. So that is what the industry will call a pension plan tax break. It is a pension wrapper. So that's all it is. So at its most simplest, a pension is just a pot of cash. You pay into it, you get tax relief on it, but there are restrictions in exchange for the tax relief about what you can do with that money. For pensions, those restrictions are how you access that money. You cannot get hold of it until you are 55, and when you take the money out, they are subject to income tax in the normal way, and I will cover that in a little bit more detail in a minute. Any pension plan is divided into two main parts. The first part is where you are putting money in, and the industry calls that accumulation, and it is a tax sheltered wrapper to save money for your retirement. You can pay money in, you can put in regular contributions, you can put in one-off payments or a combination of the two. It's really quite flexible how you can put that money in. That money that you put in is invested and grows hopefully over time, so that by the time you want to access that money, you have the contributions plus whatever interest you have earned on that money, and that is what you use to fund your retirement. And then the second phase of a pension is when you're taking money out, and technically in the industry that is called decumulation, and that is when you are drawing money out of your plan in return for either an income or lump sums or some sort of guaranteed regular income, commonly known as an annuity. And I'll cover all of these terms off in a little bit more detail in a minute. So it's basically a wrapper. You put money in, you're saving, you then come to a point you start taking the money out. It's as simple as that. You are giving up disposable income today for a future income. So at its most basic level, it's very, very simple. Why should you have a pension plan? Why should you bother? Well, the state pension is currently around 7,600-ish. If you can live on that, you're a better person than me. So you really do need to think about how you are going to supplement that income moving forward in order to maintain your lifestyle. There are two main categories of pension plan. The first one is called a defined benefit plan. These are the pension plans that people used to get from their employers. The way these work is that your employer promises to pay you X amount when you retire, and the employer is responsible for making sure they've got enough money to do that. You may have some old legacy schemes from some old employers. These are increasingly rare. They are very expensive to provide, and it's really quite rare that you will be able to access a new defined benefit plan. I mention them A, for the sake of completeness, and B, you may have some old legacy schemes from some old employers that work on a defined benefit basis. If you have a defined benefit plan, you need to look very hard at whether you want to transfer that money or consolidate that money into a single plan elsewhere, because you may be giving up some really valuable benefits by doing so. But there can be occasions when it is advantageous for you to do that. I've done it myself in a very specific circumstance. So it can be advantageous, but it is something you need to think really quite deeply about, probably need to take advice on, and actually the government forces you to take advice if your pot in a defined benefit plan is 30,000 or more. You are forced to take advice to transfer it, and that in itself is very expensive because you have to pay for that advice. So I'm not going to cover defined benefit plans other than what I've just said. I am going to focus this on what's called defined contribution plans, which is what most of us as self-employed stroke directors of limited companies are probably going to be looking at. And this is where basically you or your employer, your limited company in this case, puts money in the scheme, it's invested, and then whatever that pot is worth is where you draw your money down. So unlike a defined benefit where you're promised what you get when you retire, here there are no promises. It's just you put it in and you take out a proportion of whatever it is worth when that time comes. There are lots of different styles of plans with slightly different approaches, but they all are fundamentally the same. It's just how flexible those plans are. The ones for that I've included a list here for sake of completeness, but the ones that you will probably be looking at as a limited company director is probably the self-invested personal pension, commonly known as a SIP, or a personal pension of some description. They work basically the same way. A SIP generally gives more choice of investment options than a group personal pension or a personal pension does, but they are basically the same things. I was asked the question, are there any plans for self-employed people? Basically, they're all the same. They may be marketed, but at their fundamental level, they are all the same. There are no special plans from the point of view of the government or tax treatment for the self-employed directors. Some companies may have a few twiddles around the plan to allow a little bit more. Sorry, my screen is flicking at the moment, so excuse me if I'm a bit distracted. So some companies may offer a few twiddles around sort of some of the marketing and features on them, but fundamentally they all work the same. So they're the two types of plan. I just wanted to cover off auto enrolment because it may be a term you have heard. Auto enrolment was introduced by the government a few years ago. It is to try and encourage people to save for their retirement by automatically enrolling them in some form of pension scheme using behavioural economics. The tick box, do you want to be in or out? You are in unless you say out. Everybody is automatically enrolled. From the point of view of a limited company, if you employ anybody, if you have a single member of staff, you must provide a pension scheme for them. If you are a limited company with owner directors, you do not have to do that because technically you do not have an employment contract. But as soon as you employ a member of staff, you must set up a workplace pension for them. Your accountant will advise you on that, and I'm sure those of you that do employ people have already done this, but if you haven't, you need to get on it because you can be fined. There are details there for those people that applies to, but I'm not going to go in any more detail now. So when you are choosing a pension plan, what sorts of things should you consider? And actually some of these things apply to legacy plans that you may hold from previous employers or previous personal pensions as well. It's worthwhile thinking about these things. There are hundreds of different plans on the market. What are the key things that you should take into account? Firstly, the investment options. How will your money be invested? What choices do you have? What are the range of funds? How interested are you in engaging with your investments and monitoring them I come on to this in the next slide. And what choice do you want to have, and how often are you going to review it and potentially move those investments around? Is the fund that you are in, or the funds you are in, diversified sufficiently to reflect your risk profile, your appetite for risk, or any other concerns you may have? For example, do you only want to invest in ethical funds, or do you only want to invest in the Far East and not the US, for example? You have those choices should you choose to consider them. The second thing to think about is fees, and what pension charges do you have to pay. Every pension plan has charges, so fundamentally you can't get away from it. You have to pay for it. That's, you know, the basic principle of it. There are three main types of pension charge. The annual management charge, this is the day-to-day cost of administering the pension. 1% or less is a good fee for that. Anything above that is not. There are some figures knocking around that nearly half of people with a personal pension plan are paying more than 1%. And the impact of a high charge can be significant. There are figures that it can, over 20 years, assuming growth rates of 5% of investment, charges of, 1% or more can knock your investments back by about £23,000 over those 20 years. So it may only feel like it's sort of 0.5% here and 0.2% there, but when you roll it up over 20 years and you take into account the fact that 0.5% is no longer growing over those 20 years as well, you've lost the potential for growth on that money. It can be significant, so it is worthwhile taking a look. Most of the new plans on the market have reasonable AMCs. It might be worthwhile taking a look at some of your legacy plans, particularly if you've got older plans where those annual management charges might be higher, and thinking about switching them or consolidating them elsewhere if that is the case. There is often a platform charge. That's the cost of the platform you use where you buy and sell shares or switch your funds around. And then there is also a fund charge. So each fund that you are invested in has a cost associated with it, and that cost varies according to the type of fund, the type of manager. So if you go for a high risk and what is called actively managed fund, i.e. one where the fund manager is poring over details each and every day and switching stuff around all over the place, you're going to pay more than a fund where they've basically said once a month we'll take a look, and if it's okay, we'll leave it. And you can get those two different types of funds and pay more or less. What you go for is up to you and your appetite for risk. But do try and think about fees and keep those fees to a minimum, because they can really eat into it. The other thing to think about is exit fees. If you leave the plan or transfer the money to another plan, i.e. consolidate your pensions together or take benefits early. I was caught by a very old plan that I had, and the transfer fee was half the value of my pension pot, which was just ludicrous. So I was sort of between a rock and a hard place. If I transferred out, I'd lose half the money. If I stayed there, I'm paying massive fees the whole time. So it was a really difficult situation. In that event, the government actually intervened and changed the rules and made companies repay fees because it was deemed to be unreasonable. But I'm sure other people are being caught by these things and may not be aware of it. So it's worthwhile having a look at your fees. The other thing to think about is flexibility. How much are you allowed to put in? Minimum and maximums. Can you mix and match? Can you put in lump sums and regular amounts? If it's your own pension plan, can your employer pay into the scheme? So, for example, as a self-employed consultant, you might have set up your own plan. If you are then on contract for a year or 2 years and that contract has pension benefits, do you have to set up a separate plan with that new employer, or can that employer just put into your existing plan? That's something to think about. And increasingly, I think the most important thing is managing your investments online. Can you go online and take a look? Can you just go and double check what's happening on your pension, how it's doing, where the funds are, what it's worth? Particularly important if you're sort of getting 10 to 15 years out and trying to plan your retirement. So actually having that accessibility and visibility of your pensions is really, really important. And that actually may be a reason to consolidate some of your pensions together as well, to have that. It's a tricky, there are hundreds out there. It's a tricky thing to choose one. Make a bit of a short list, ask for the key facts documents, look at these elements, and then select one. If you go for some of the big companies, you're not going to go far wrong. In all honesty, they all work roughly the same. The other thing to consider if you're thinking about making pensions contributions is whether existing plans will accept contributions or have special benefits. So if you have a legacy plan from an old employer, they may well have negotiated a very good AMC on that plan. I've got some plans with AMCs of 0.4 or 0.5, which are extremely good. I could consolidate them, I could move them elsewhere, but I'm not going to do that because the fees are so cheap. And if I could put more money into any of those plans and get that same low management charge, I would do so. So that's something to think about as well. So managing your pensions investment. Now, I'm sorry if I'm teaching you to suck eggs here, but this is something I hear from consumers the whole time. They say, my pension is with Aviva. It's invested with Aviva. No, it's not. No, it's not. Your pension is an investment. You may have the wrapper with Aviva, but underneath that, you will be invested in an investment fund, and that investment fund could be with anybody. So, for example, I have a Aviva pension, and I am invested in a BlackRock fund and an L&G fund through Aviva. And lots of people do not appreciate that it works like that you have the wrapper with one company and then the funds could be with anybody else. They could well be an Aviva fund, but it is separate from Aviva the company. It is an Aviva fund or someone else's fund. So at some point, someone somewhere has made a choice of investment for you. You may not remember it, you may not be aware of it, but someone has made that investment choice for you, and you need to look at your statement and find out where you are invested. If you do not remember making that choice, you may have gone into what's called a default fund. These are funds that are general funds that are set up for people who either can't or don't want to make their own investment choices. They are general funds. They may or may not be the best funds for you, given your risk profile or your priorities. So it is worthwhile going to your statement and having a look at where your fund is, where your money is actually being invested, so that you can actually make a choice and decide, actually that feels a bit high risk for me, I want to go into a lower risk fund, or vice versa. So it is really important that you understand the investment aspect to a pension. Most pension schemes involve an element of risk. Investments can go up or down, but they are typically long term, and long term is in this instance 20 plus years. So generally the trend is for them to grow. Just a quick note on what a pension fund is. It's a portfolio of assets, stocks, shares, bonds, cash, property, and the mix of those varies across different funds. And you must monitor your pension fund to make sure that you're making the most of your investment. How it's invested, is it diversified to manage risk and reflect your risk profile or preferences? It's really important to do that. It's normally good to have a blend of assets to diversify, to not have all your eggs in one basket. So think about that as well. And there are some very good what's called managed funds, funds that invest in a broad range of different assets. We're not, pension companies aren't asking you to all of a sudden turn into an investment guru. They do have these funds that have a broad basket of different assets in there for you that you can just choose to go in those. But it is worthwhile taking a look and thinking about, is that the right fund for me? Does that reflect where I want to be in terms of where my investment is? The other thing just to note is that pension companies often offer what's called lifestyle funds. Now, these funds are general default funds, and as individuals approach the target date of retirement, they move away from the riskier stuff and into the safer stuff. That's fine, and that's a good idea if you are going to retire at the date you said you were going to retire, say 55. But actually, if you know that you are going to not retire at 55 and you're looking to work till 65, do you really want to be in the equivalent of cash for 10 years? Do you really want your pension investment not to have the opportunity to grow other than a very basic cash level for those 10 years? So again, it is worthwhile understanding what funds you're in and whether or not they match with your retirement ambitions. So pension and tax. This is horrendously complicated, and I have tried to simplify it. So bear with me, please, and don't ask me any really difficult questions, those quantities out there, because I'm not promising I'll answer them. But effectively, there are 4 deductions or taxes that you need to be aware of before we even start talking about how they're applied to your pension. So the first 2 I'm sure you're familiar with are income tax and dividend tax. Income tax, obviously I've put the rates here, your personal allowance, basic rate tax, higher rate tax and additional rate tax. Dividend tax, similar bands but different amounts of taxation. So you can see at the basic rate tax, income tax is 20%, dividend tax is 8.75%. Your accountant will be minimising your income tax and maximising your dividend tax on your drawings, and you can see why. You're saving that, sort of 11.25% tax effectively by taking it as a dividend rather than taking it as a salary. So you need to be aware of those 2 types of taxation. The other 2 things you need to be aware of are national insurance contributions that you pay and that your employer pays. So you as a limited company will be paying a national insurance contribution as well as you as an individual, and also corporation tax, which is currently 19%. That's going to go up to 25% next year. There are some twiddles this year because there have been some mid-year financial changes that have made it not quite as simple as I've tried to make it here. Those changes, assuming Liz Truss doesn't do anything drastic, will go away next year, and everything will be a bit more simplified. But just be aware that I have simplified the figures here just to make it easy to understand, because if I tried to incorporate the mid-year changes that the government has talked about making, it would be a nightmare to try and explain it to you. But this is the principle of what you need to know here, these 4 taxes. So If you are making personal contributions and claiming tax relief, what is the situation? You cannot claim tax relief on pension contributions based on dividend income. You can only claim tax relief on pension contributions based on your salaried income. Obviously, from a tax point of view, you are minimising your salary and maximising your dividends. So here what we're seeing is a slight counter to that, because you're now limited, because you're taking most of your income as a dividend. You're limited in terms of how much tax relief you can claim on your pension contributions because your salary is minimised. The maximum you can pay in to your pension from your personal funds during a single tax year and claim tax relief is either 100% of your relevant earnings, which basically, for all intents and purposes, is your PAYE salary. And that is the real limitation for us as owners of small limited companies, or £40,000, which is the annual maximum annual allowance that applies across the board to anybody. So you can pay in more than those amounts, but you cannot claim tax relief on it. And given that the main benefit of saving into a pension is the tax relief, you may well be better off putting any monies over those tax allowances elsewhere, because otherwise you're getting the limitations of a pension without necessarily having the tax benefits of a pension. The tax relief you can claim is basic tax relief of 20%, which is typically done automatically for you. You don't need to worry about that. The pension provider on the more modern plans will do that for you, and it's added to your pension pot relief at source. And then if you're a higher rate taxpayer, you claim the additional amount, which is either 20% or 25%, depending on your tax status, through your self-assessment tax return. So that's how that works. You can go on the internet and find loads of illustrations and examples of, why it's a good thing to put money into a pension because of this tax relief, and indeed it is. It can play a really important part in boosting your retirement savings because effectively they're being topped up. It works slightly different, but typically this is the example that you will see. This is from Money Savings Expert, but if you invest £100 in a pension and you're a basic rate taxpayer, you get tax relief of £20. Higher rate taxpayer is £40. Top rate taxpayer is £45. It's not quite as simple as these illustrations show, because at basic rate you're boosting your pension. At the higher rates you are getting a tax discount. But for all intents and purposes, this illustrates the point very, very well. The other thing to consider when you're thinking about investing as a pension is that when we are working, we are likely to have a higher income than when we are in retirement. So it is worthwhile putting money in at our highest rate of earnings and potentially getting tax relief at the higher rates. When we retire, we're likely to drop a tax bracket or two, and therefore we will be taxed on the income coming out of a pension at a lower rate than we are taxed generally when we're working. So typically it is more advantageous to put in now while we're earning, because we will be taxed less when we're in retirement because our earnings will be less. So what about making contributions through your limited company? How does that work? As a company director, you can make contributions both as an individual and as a company, if you see what I mean, through employer contributions. And typically you are advised to do this by accountants because the combination maximises the tax benefits that you have, but it does depend on your individual circumstances and your business's profits as well. So rather than drawing extra income to pay a personal contribution to your pension, your company can make that contribution on your behalf. And because it's from the company, which is a different legal entity than you, it is treated differently for tax purposes. What you can then do, if you combined some personal contributions and some corporate contributions, is claim tax relief from personal tax relief from your earned income, corporation tax relief from the corporate contribution, and you can still be paid tax efficiently by taking the bulk of your income as dividends. And this is typically what owner directors of limited companies will be doing, but it is really, really complicated, and I'll show you how complicated in a second. When I looked at on the internet, there were various figures sort of bandied around, but typically it was around a 35% saving by using this limited company contribution method. You are saving around 35% on a combination of tax and other deductions that typically you would have to make. So making contributions for your limited company, the benefits, they're an allowable business expense, so you don't get corporation tax on them. They come out of pay before NICs are determined, and NICs are national insurance contributions, I apologise, is a significant sum of money on a salary, so that can be a significant saving. There is no dividend tax on the money you sacrifice. So effectively, if I say instead of taking £60,000 as a combination of income, PAY income and dividend tax, I'm going to take 45,000. I'm reducing my personal tax bill. That other 15,000 is put in by the company. There are all sorts of benefits of doing it that way. And importantly, contributions are not limited by the size of my salary. As I said earlier, we tend to limit our salary size to make it tax efficient. If you do it this way, you are less limited. What are the limitations of doing it this way? Firstly, you must meet HMRC's wholly and exclusively rules. Basically, that means any pension contribution has to be appropriate for what you're doing. So you can't give yourself £200,000 if typically a director of a similar company would only earn £10,000. They would look at that and assess how reasonable that pension contribution is. It also, the implication of that is that if there are two directors in a company, you both have to have the same contribution made by your company to your pension, and that goes across if one director is employed and two directors are owners, then all three of you have to have the same or similar contributions made for you. So that is something to bear in mind if there's more than one person within the company. The pension contributions that the company can make are limited by the company's annual profits. Again, this is potentially a limitation because our accountants try and minimise our profits declared so that we pay minimal corporation tax on it. So you do need to take that into account. The contributions made by your employer do count towards your annual allowance. So that £40,000 cap that I talked about earlier you can't get any additional tax relief on that as an individual. You can't make more contributions than that, and obviously you can't claim individual tax relief on those contributions. I have tried to calculate this for you to show you how it actually works. Now, it is horribly complicated. You're trying to juggle lots of different tax regimes at the same time, but I have given it a go for you. So the example I am going to use is that of a total gross income of £60,000 from which you want to make a pension contribution of £15,000. I have not taken into account any other tax or corporate personal or corporate tax circumstances at all. Every accountant will be turning in their grave at this point. And I've chosen 60,000 because it shows the impact of the higher rate tax bands. If you take less than 60,000, the differences will be more marginal in the taxation regime. I am not guaranteeing that these figures are 100% accurate. They are accurate to the best of my knowledge in principle and how they work. So please do take them with a bit of a caveat, but they're reasonable illustrations of how it actually works and how you should be thinking of it. So I've got 3 examples to run you through quickly. The first one is a totally salaried approach. So in this example, I'm assuming that you are taking the full £60,000 as a salary. All of that is taxable income. And you can see down here, I have run through the tax that is applied to that as a full PAYE income. So you've got personal tax on that of 11,432. There is also a national insurance contribution bill for both you as the employee and your company as the employer. There's no corporation tax due on salaries because it's an allowable business expense. So in this instance, the total tax and NIC due on that £60,000 is in the region of £24,000. You then decide to put £15,000 of that money, that salary, into your pension. And here are the tax reliefs that you get on that money. You can see that the tax relief, the higher rate tax relief that you claim is limited to the amount that you have paid higher rate tax on. So 40% tax on 9,730 is 3,000 odd. You claim the extra 20% on that same £9,730 to get it back. You do not get additional tax relief on the remaining 5,000. So you're putting £15,000 in. You can only claim tax relief on the 9,730 that you've paid that higher tax relief on. You do not get it on that balance, if you like. So the total pension relief you get is 4,946-ish. I've put caution on all of these. Please take them as illustrative, as I've already said. If you want to do the same exercise, but you are paying yourself through a mix of dividends and salary, so you're taking £9,100 as a PAYE salary and 50,900 as dividends. Why 9,100? I hear you all asking. Because that is the threshold for employer national insurance contributions. So quite often your accountant will advise you to only declare that as a PAYE salary so that you don't have to pay employer NICs on it. So that's why I've chosen that amount. So your personal tax bill on your dividends is just under £6,000. That is a combination of PAYE and dividend tax. The thing to point out here before we move on to the next slide is the higher rate dividend tax that you're paying, 33.75% on the amount over 50, just around £50,000. You pay an additional amount on that. So that is important to remember for the next slide. Your company also pays corporation tax on profits before dividends are distributed. So that's 19% on your 50,900 that you've taken. But because we've kept your salary below the NIC limits, there is no NIC payable. So your total tax here is 16,000 odd. You decide to put £15,000 into your pension. but you can't claim tax relief on all of it. You can only claim tax relief on the amount that you have paid tax on your salaried income for the year. So the maximum you can claim tax relief on is 9,100, your PAYE salary. So you only get 20% tax relief on that amount. You do not get any pensions tax relief on the dividend portion of that £15,000 that you've put in. And potentially, as I've already said, why would you want to put that extra money in a pension with all its limitations and not get the tax relief? You might as well put it elsewhere. So your pension at retirement could well be smaller if you choose to do something else with that money. But effectively, you can see that the total tax in NIC is 16,000, and you're getting correspondingly less pension relief from that amount. So what does it look like if you make contributions through your limited company? So in this instance, you are taking, as a mix of salary and dividends, £45,000. So you are sacrificing £15,000 of your dividend income in exchange for the equivalent pension contribution from your company. So what happens here is that your personal tax bill is reduced because you are not knocked into that higher rate tax band, dividend tax band that I was talking about earlier. So your corresponding personal tax bill is significantly reduced. Your company obviously still pays tax on profits before dividends are distributed, but your dividends that you're taking are less, so your corporation tax is also less, correspondingly less. So your total tax in NIC is 9,500-ish. Your company then puts £15,000 into your pension on your behalf. The company can put in as much as it wants. It is not limited to your salary, so it can put in the full £15,000. Now, as I said, you could have put in the full £15,000, but why would you want to do so when you're not getting tax relief on it? In this instance, the company is less limited than you as an individual, but equally you get no personal tax relief on that money. It's the company that gains the tax relief. Because pension contributions are an allowable business expense, your company does not pay tax on £15,000. So you are effectively saving that equivalent corporation tax, and your income. So when your company puts in £15,000 into your pension on your behalf, your personal tax relief is zero. You are getting nothing back from the government on that. However, your company is paying less in tax, and you are personally paying less in tax because you're effectively sacrificing your salary in exchange for a pension contribution. So you can see why you would want to do this. There is a significant saving to be had by doing it through your company rather than doing it personally. There are potentially some drawbacks in terms of you are effectively lowering your income. It could affect your credit, or your if you're applying for a mortgage, for example, your mortgage lender will look at a lower figure rather than a higher one. So you do need to think about things like that. But in principle, making contributions via your limited company is a significant tax savings. If you and that saving gets greater if you are a higher rate taxpayer. The differences are more marginal if your salary is always below those limits. Right, so I hope that has made sense. Do look at those in your own time. I'm very quickly going to go through pensions and ISAs and what the differences are there. Similar to a pension, an ISA is a wrapper. It works differently, a tax wrapper. It works differently from a pension in that ISAs are taxed on the way in. Pensions are taxed on the way out. So any money you put in a pension from your personal income is effectively tax free. You are taxed when you take it as an income out. Any money you put into an ISA is from pre-taxed income. But when you take it out, you do not have to declare it. You do not have to declare any growth on it. So it's just a different way of looking at the taxation. Typically, pensions are a better option because you've got the growth potential on that money, on that untaxed money, than ISAs. But horses for courses on that. How much can you pay in? It's typically recommended you put in as much as you possibly can. I would say take a look at what you think you need to maintain your lifestyle and work back from that. And then look at affordability and so on from that. There are technically no limits on what you can put into a pension, but there are limits on how much tax relief you can get, and that was a question I know that was sent through beforehand. You can put in whatever you want into a pension, but you cannot claim tax relief on it. Tax relief is available on the lower of your annual earnings, your PAY salary, or £40,000. There are some twiddles around that in terms of carry forward allowances and so on, which I've explained below there. I'm not going to go into those now, but there are a few twiddles around it. But basically, at this point, it's the lower of your PAYE earnings or £40,000 that you can claim tax relief on. And there is also the lifetime allowance to take into account. This is the big news from sort of GPs and consultants, hospital consultants and so on, that we saw a year or so ago. If you've got over £1 million in your pension scheme, you might be taxed on it. Frankly, if I had over £1 million in my pension scheme, I wouldn't be moaning. So it's the lifetime allowance is there for sake of completeness. If you're in that position, good luck to you. When can you access it? You can take as much money out of your pension as you like from age 55. That age is rising to 57 in 2028. But any money you take out is income, so it's added to any income that you already have. You do have an initial 25% tax-free amount that you can take out. You can either take that out as a lump sum or as drip fed. Every amount you take out has 25% tax-free with built in within it. The option is up to you. But other than that 25%, any other income payments or lump sums are subject to income tax in addition to your earned income. The trick here is to work out how much you're going to take out in a year, or how much you are going to earn in a year, your state pension, your income from any pensions, any other income you might have from properties and so on, and juggle and make sure you don't go over a limit inadvertently, because you'll be clobbered for tax on it. So you have to be a bit clever and just keep an eye on your finances and try and juggle, if you can, how much you're taking out in a year in a tax year, to make sure that you maximise the tax advantages of doing it. One small thing to mention is that the first time you access your pension provider will deduct income tax at an emergency tax code, which is eye-watering. So the first time you take money out, you'll need to reclaim it back through your tax return. Subsequent to that, it's done automatically for you. The pension provider will deduct the income tax automatically, but just that first time, just be aware that you have to declare it in order to claim it back. How can you take your money? You can exchange all or some of your pension pot and buy what is called an annuity. This is a one-off decision. Once you bought it, your money's gone, and you have the promise of a secure income for the rest of your life. It will never run out, but it can't be changed what it's set up. So basically, you're paying money for that guarantee and that promise moving forward. There are different types of annuities you can buy. I'm not going to go into them now, with different benefits, but basically that's that's the deal. You can go into something called drawdown, which is the sort of more modern pension, and you can take a flexible income directly from your pension. You can decide, I want to take £300 a month for 6 months. 6 months later, oh, I want to take a lump sum of 10 grand. I want to change the income I'm taking. They really are very, very flexible and allow you to play around with it. But your income is not guaranteed. The money that you don't take stays in your pension. It's invested and it is subject to the vagaries of the stock market in the same way as any other investment is. Also, you'll be paying charges on that, which I've already mentioned. Or some companies may offer you to stay in your current pension scheme and just have the flexibility within that pension scheme to be able to take out lump sums or whatever. Generally, if you stay with your current pension provider, they're not as flexible, but things are getting better and pension providers are getting more and more flexible. But drawdown tends to be the most flexible option for taking money out. And finally, you'll be pleased to hear what happens when you die. Generally speaking, pension pots are not subject to inheritance tax. Anything you've taken out is treated as income in cash and will form part of your estate, but the actual pot that stays in the plan typically is not subject to inheritance tax. So if you're in drawdown or F plus, your pension will go into your estate and your beneficiaries can access it, typically tax-free. Note there are some twiddles around that when you hit the age of 75, which may mean that the pension is taxed for your beneficiaries. I'm not going to go into those now, but you just to make you aware of those. If you've bought an annuity, as I've already said, it's a one-off purchase. You decide when you buy it what type of annuity you want and how long it will carry on. So for example, you can buy a widow's annuity so that if you die, your spouse will continue to get a reduced income on your behalf. They are more expensive. They mean that your income is reduced in the initial term in order to pay for that length. You make that decision at outset, and once you've made that decision, then that's it. I have put a little "how long are you likely to live" slide in there, which is quite an interesting thing to look at when you're considering these things. Phew, sorry, that took a long time, but we're there. Hopefully that was interesting and useful for people.
Claire, that was absolutely amazing. Thank you so much. I mean, I certainly learned an awful lot, and I think it'll be very, very useful for us to be able to refer back to. Unfortunately, we literally have just 3 minutes left. So if there is one burning question that somebody would like to ask, then go ahead now, or ever hold your peace. Any questions? Can't see any. So I think it just remains to say there's lots of words of thank you coming through in the chat box, by the way, Claire. So we really appreciate the amount of time you've put into preparing this. Can we have the slides? Would you mind if we put these on our website? That's something?
Absolutely not. That's fine. Yeah.
Yeah, okay, that's wonderful. All right, well, I think it just remains to say thank you very much on behalf of all of us. And thank you to everybody for logging in. Do join us again for a future webinar or one of our lunch and learns. And have a wonderful afternoon, everyone. Bye.
Bye.